Hey, how's it going? I'm Ron Sneller, registered financial consultant, breaking down one of these whole life infinite banking policies here. This one's from Penn Mutual. I'm just going to go through some of the policy features and functions, how some of this stuff works, and then also go through a loan scenario, just showing a couple of generic examples just to help people understand this better. This is one of the clients we're working with here right now. You can see value client. She's 52 years old. We're assuming she's standard non-tobacco. She and her husband are wanting to put in $100,000 per year, and they're wanting to do it quarterly. So it's $25,000 per quarter. Now you're going to see with the policy payment period, that's going to say 48 years, right? We're not planning on paying on this policy for 48 years, but we use ordinary whole life. So ordinary whole life, when we set it up, it's like you're just going to pay on it forever. And if you're lucky enough to reach age 100, then your premiums will be done. So that's where that number comes from. It's her age of 52, add 48 years onto that, and that adds to 100. But what you're going to see, we're going to customize this policy, and we're going to do what's called a reduce paid up, probably after 7 or 8 years. And I'll show you how that works. When she puts the first premium in, that first, once she's approved, she puts in the first $25,000 quarterly premium. She's going to be insured for a total of about a $1.5 million. That's a combination of about $750,000 base premium, then the $750,000 term rider. Okay. We're going to scroll down and look at the illustration and the projections here momentarily. But before we do that, this whole life policy is done through Penn Mutual. Penn Mutual is an A+ rated company, and they have been around since the 1850s. So they have been in business literally since before the Civil War. So they've been around a very long time, very strong financials, and a very, very strong dividend history. Okay. Dividends, you kind of think of it, it's almost like the profits that the insurance company is paying back to you. But in the insurance industry, it's coded, or it's classified as a return of overpaid premium. And to me, that's just like a little like wink, wink to the IRS. It's a tax loophole. And what it allows the dividends to do is be reinvested back into the policy with no taxation due. So cool stuff there. You're going to see that this illustration is the supplemental ledger. It's customized for these clients, and we're using the current dividend scale. Now, dividends aren't guaranteed. They're not set at the exact same level every year. But with life insurance, they're pretty conservative with their dividend projections. And again, Penn Mutual has been very, very consistent. Now, they can change or fluctuate a little bit just due to the company's expenses or mortality experience and how their investments are performing. And actually, with interest rates rising over the last couple of years, I'm filming this on March 5th, 2025. With interest rates rising over the last couple of years, Penn Mutual and many mutual life insurance companies have actually increased their dividends here recently. So that's a good thing. But as far as like the guarantee, yeah, there's no guaranteed dividends, but Penn Mutual's paid dividends for over 100 years in a row without missing any, including through the Great Recession, including through the Great Depression, right? And when I say Great Recession, I mean the Great Financial Crisis of 2008, but all the way back to the 1920s through the Great Depression, Penn Mutual's always paid a dividend. So with these companies, like to consider like what the guaranteed side would look like, I mean, we're thinking conspiracy theories, end of the world theories, economic Armageddon, right? That one of these big companies would stop their dividend and then never pay another dividend ever again. So we're going to look at this right here based on their current dividend scale, this projection, because this is much more likely and realistic to happen. So kind of scrolling down here again, so you're just going to kind of see how it says non-guaranteed right there. Again, this is just a projection based on today's dividend rates. And there's a lot of columns here. There's a lot of things for your eyes to kind of focus on. So it could be a little confusing. So I'm going to use my drawing tool and kind of focus in on what we're doing here. Okay. So looking at this column right here, this is a total premium. This is very easy math here with these folks. That's why I'm using them for my example, because $25,000 a quarter, that adds up to $100,000 of premium per year. Now, what you might notice, and we're going to come back to this here momentarily, but what you might notice is we're illustrating that they're going to stop paying premiums into the policy as soon as they can. And with this policy, it's going to satisfy what's called the 7-pay test within the Internal Revenue Code. It allows us to stop paying the policy's premium, but still operate within the IRS guidelines. So all of the life insurance benefits are tax-free. You can access or borrow the money from your policy tax-free, things of that nature, right? But we're doing $100,000 a year. And the reason that we're doing this here is that the clients are not locked into stopping after 7 years. If they've still got money coming in, they want to keep funding their policy, they can continue to do that. So that's the reason I structure these policies using ordinary whole life, but then looking at a time where we can do the reduce paid up and stop paying. But it's flexible and it's up to the client. Again, you got to do it for at least 7 years in order to kind of play by the IRS's rules and keep all the preferential tax treatment of life insurance. So when she puts $100,000 premium in, first thing that's going to happen is we're purchasing life insurance, right? So you kind of notice like earlier on day one, she's insured by for 1.5 million. By the end of the first year, after the dividends are calculated and the interest is calculated, you can see that the total death benefit goes up to almost $1.7 million, meaning that, if she were to pass away at that point in time, the life insurance benefit, Penn Mutual is going to pay out 1.694291 to her spouse, who is the primary beneficiary, right? So let's take a look now, because we know we're buying life insurance, right? But we're also, the real reason that we're using this policy is as an asset that we can build equity and then borrow against and kind of like become our own bank and take back control of the lending function in our lives. It's a great process. I utilize this a lot with my clients. I utilize it in my own life. But it's not a get rich quick scheme, and it doesn't happen overnight. It takes a few years to build up equity, right? So I'm going to kind of go through this, and we're going to take a really transparent look at the cost of the policy and how this functions and how it works. We're going to take a look at year one right here, because year one is where most of the costs of a whole life policy are loaded into, because the insurance company is most at risk, right? They're on the hook for a really large death benefit. And relative to what you've put in, like you've put in relatively little in order, or I guess in relation to what they're insuring you for, right? So we can see the cumulative premium outlay at this point is $100,000. And the way that we set these policies up, it has a lot of cash value right in the beginning. Ordinary whole life policies don't have any cash at all in the first 2 or 3 years, but we structure these policies in a specific way to give you early access to cash. Now, it's not, you're going to see right here, the total cash value in year one is $71,374. So after the first year, we're at a 71% equity position. No, not zero, like most ordinary life insurance. But again, we don't have access to all of our cash. Right? It's not a bank account. It's not a savings account. You're purchasing an appreciating asset, and there is a cost to that asset, right? The cost is the life insurance in this case. But over time, this is really going to get growing. It's really going to get cranking. And so we'll take a look at that as well. But this column right here is going to show us very transparently, like in year one, when we put in $100,000, we can see that $28,626 is not going into the cash value. It's being held back to pay the cost of the insurance, like God forbid, if she were to die in that year. Okay. And what you're going to notice is that each and every year, the cost component is going to go down, until basically like it's gone. For all intents and purposes, meaning like the compound interest and in the dividends, in addition to the premium outlay, is going to be more. We're going to have a positive cash on cash return in that year, right? But we take a look at year two, we're not quite there yet, right? So you're going to see like the negative, or the amount that we're behind, is $19,000 that year. So we're putting in $100,000, right? So total we've put in $200,000. Now that year, on the $100,000 that's being deposited, $80,000 of it is being credited right into the cash account. So by the end of year two, the projection is to have $152,000 of cash, right? At that point in time, you can borrow up to 90% loan to value of whatever your cash value is at any point in time, 30 days after the policy is issued. So if they hadn't taken any loans by the end of year two, you got $152,000. Guess what? You can borrow 90% against that. Right now, maybe they won't need 90%, but they could certainly borrow $100,000 from it. That's only about 67%. Loan to value on the equity. Now, the key is, even if you were to borrow against the policy, let's say that we took out $100,000 right there, guess what? It's not a withdrawal. We're not reducing the amount of savings that's working for us. So the cash value is going to continue to build and grow on the full $152,000 as if we never withdrew any money. Because we didn't withdraw any money. We borrowed against an appreciating asset. And the reason that wealthy people have learned to utilize debt, several reasons. Number one, tax advantages. You don't pay any money on debt because, any taxes on debt, because debt is not income, right? Number two it allows your asset, like this cash value, to continue to grow and compound uninterrupted. And then number three, it's leverage on your money, right? Because you're getting access to OPM, other people's money. So the insurance company is using your life insurance policy as collateral to extend a $100,000 line of credit to you. And now you've got money working for you in multiple places at the same time. It's still growing and compounding in your policy, completely tax-free. But now maybe you've taken this and you went out and maybe you bought a duplex, right? And now you have some real estate. You have an asset that's going to appreciate and kick off cash flow, and maybe get some tax advantages from the depreciation in the tax code. So that's leverage, and that's why people do infinite banking, right? So let's kind of, so that's the reason why we would do this, and kind of showing you, even in the early years, like you could still borrow against your policy. Now let's kind of go back and take a look at some of the costs. I want to finish this off. You're going to see in year three, she's putting in $100,000. In that year, we're still a little bit behind, right? The projection is we put in $100,000, 2,700 of it's not going into the cash value, but $97,000 of it is. And you're going to see, like, at the end of year three, the projection is to have just about $250,000 of cash value that we can continue to borrow against. And then notice each year, as we're putting premium in, the death benefit goes up and up and up each year that we're putting premium in. Okay. Now let's take a look at year four. So what's going to happen in year four? You're going to notice, like, this number right here, it's no longer negative, which means we actually have a cash on cash return that year. Now the math here is pretty easy, right? Like, we're putting in $100,000. We're getting $4,500, you want to call it $4,600 credit over and above what we're putting in. Very easy math. That's a 4.6% cash on cash return that year. Nothing to write home about. I mean, you could get that maybe in a money market today, or maybe a little, maybe money markets are a little bit less now. But the point is, we finally start to get a cash on cash return, right? So we put in $100,000. The credit to our cash value is $104,573. That goes into our cash account. And then in this particular policy design for this client, it's year five where this really starts cranking, year five and beyond. Because take a look at this, like, we're depositing $100,000 and we're getting credited $12,450 over and above. So the total credit to the policy is $112,450. Right. So that's about a 12.5% cash on cash return. It's like I tell people, if you're using this to kind of become your own bank strategy, it's like, imagine going down to a traditional bank, like, just in your neighborhood or wherever you bank at, and deposit $100,000, and they end up crediting your account or crediting your policy $112,000. Right. It's just not going to happen. So absolutely unbelievable. Now with these folks here, I'm just going to look at year seven because that's the last year as of right now that I'm planning that they're going to put money into their policy. But again, the deposit that year is $100,000. The interest credit is $22,843. So that's almost a 23% cash on cash return in that year on that deposit. So they put in $100,000. The total credit to their account is almost $123,000. Now, if they continue to fund the policy past year seven, you're going to notice that the cash on cash return gets better each year as the policy matures and gets older. It's compound interest working for you. It's interest building on top of interest. So it's going to get better and better and better. So they might want to, instead of turning it off in year seven or after year seven, they might want to continue to put money in because it's just going to be better and better. Right. But I'm just showing them, like, hey, just worst case scenario, what's the minimal time that you can fund it for? So we're just kind of looking at that, right? And then we're projecting after year seven, we're going to turn off the funding of the policy, and that's called a reduced paid up option. So the insurance company is able to say, hey, listen, based on the amount of premium that you've paid in and the interest and dividends that you've earned, if you want to stop paying premiums, we're going to lower your insurance amount, but we're able to calculate how much life insurance that you now own and that you can just walk away without paying any more premium. And so in this specific client's case, what you're going to see right here is that when they do the reduced paid up amount, you'll see it's going to go down to basically where we started at, which is about $1.5 million. Okay. Now, what do you notice about the death benefit at that point? The death benefit is going to continue to start growing again, because even though we're not putting in more premium, it's still earning interest and dividends on this policy, right? And so that is going to continue until they start taking out retirement income potentially down the road. Going back to year seven, you're going to notice that at this point in time, I guess we've got the policy like fully funded, at least for this example. We've got $700,000 into the policy. We have access now to all of our cash value. So the policy is broken even, so to speak. And then at this point, if we're not putting any more interest in, this right here is just going to grow around 5% every year, year over year. And you're going to see that, even once that happens, I mean, there's still the death benefit on top of the policy, right? So that's a good thing. And so they're just able to borrow against this and pay themselves back, whether they want to use it for fun stuff like cars or family vacations, whether they want to use it to expand a business or buy more real estate. This is just something where you can borrow against the policy. There's no credit checks. There's no required repayment plans. There's no appraisals, very, very little paperwork, and it doesn't go on your credit report. You just contact my office and you tell us, this is what I'm thinking I want to do. This is how much money I want. As long as it's within the 90% loan to value range, all we do is you just sign a piece of paper, and that's it. We submit it and then to the company, and then it takes usually about 3 to 5 business days to process. They deposit the loan right into your bank account. So this is a way that you just kind of see here, a very low risk way that you could build up, to $1 million plus, but you can use your money as it's still growing by simply borrowing against it, doing other things with it, whether it's investing or personal consumer type things, and then simply paying yourselves back, right? And if that happens, you're borrowing against it, you're paying yourselves back. I mean, down here, it's not going to affect your growth rate. You're still going to have around $1.2 million, and you're going to be good to go. I'm just going to toggle over here real quick to the same thing where we just ran a couple of loan illustrations now, just kind of showing like, hey, after the, after the second year, we've got $152,000 of cash value available. Remember, we talked about that. Well, what happens if we borrow $100,000 against it, right? And on this example, I'm showing them paying back $1,500 a month in addition to the premium that they're putting in, right? So you're going to notice that the total premium over here is still $100,000 a year, but the premium outlay, like right here, it's going to change. Why? Because they're adding $1,500 a month of loan repayment. So that's $18,000 a year. And so that's why it says $118,000. So you're going to notice every year as they're paying back the loan, guess what? The loan balance is dropping and the cash value is going up. Pretty exponentially, right? Like they're putting $118,000 into their policy, and the policy is going up by $126,000. Again, that's because you're still compounding the interest, right? And then we get to the point like in year 7 where the loan is pretty close to being paid off. Okay, cool, no sweat. But we've got almost $700,000 of cash value, right? And so we're going to borrow, again, this is just an example. We borrow $500,000 out, and I don't know, maybe that's 5 down payments of $100,000 each on 5 rental properties, right? I mean, it's really up to you. Or maybe it's like one bigger apartment complex, or maybe you're going into a syndication. I mean, the opportunities really are endless, right? But we're borrowing $500,000 out. Now, when we do that, you're going to notice that your net cash value drops, but you still have $244,000 of cash. If you needed more on your line of credit, you could go get more if you needed to, right? You're nowhere near your limit. You're also going to notice, remember that when we did the reduced paid up, the death benefit dropped to about 1.5 million. But then right here, it's going to drop further. Why? Well, because you took 500,000 out as a loan. If you were to die in that year, the life insurance benefit is going to pay off the loan, and then your family is going to get the net remaining amount after that. Okay. And then just going back to the loan repayment again, and I'm just making stuff up for simplicity's sake, just to kind of understand this. I'm showing this case, they're paying back $5,000 a month. Now, at this point, there's no premium that they have to save or that they have to worry about. Now it's just loan repayment. So they're paying back $60,000 per year. You kind of see that until it's paid off. And you're just going to notice every year as they're paying back the $60,000, the loan balance is dropping and the cash value is going up. Right. And you're just going to notice like we're injecting $60,000 of loan repayment into the policy, but you're going to notice that it's growing from here to here. It's a heck of a lot more than $60,000, right? It's growing by about $74,000. And again, that's because your policy is continuing to grow and build and earn compound interest. Okay. And so we're going to get down here. Right, let's kind of scroll down to like age 70, and you're going to see like that's right here where this is where we're finally getting the loan balance like paid off, and then we've got almost $1.2 million. And then a lot of times people will actually take their cash value and then kind of convert it to a tax-free income stream. And what that looks like is a series of systematic loans against your policy. The calculations we did here, this level of funding, this policy can sustain $85,000 a year. So it's almost it's a little bit more actually than $7,000 $700,000 a month, almost like a tax-free pension, right? Kind of cool. And so the way that works is each year that you take those distributions, what's going to happen is that your death benefit is going to come down. You're taking money for yourself. And what we do here is we withdraw the cash value up to the basis, and then we switch over to a series of systematic loans against the policy. Why loans? Again, because loans are not taxable. They're not reportable. It allows us to function tax-free. And so what we did here is we just modeled out like a 20-year pension from age 70 to age 90, right? And then you're just going to see, like, at that point in time, if she's still alive, like there's not going to be any more resources that can come out of this policy. We've pretty much tapped it out, right? But just, kind of notice, like, the totals here, right? So like total premium we put into this policy is $700,000, right? Like this right here, we want to kind of ignore that because that's like the 700,000 we put in, plus borrowing out and repaying over time, right? The actual premium we put in to create the policy was $700,000. If we take $85,000 and multiply it by 20 years, right? 20 years is the pension. That's over $1.7 million tax-free. So you're going to see just on the retirement income, we profited over $1 million without paying any income tax on it and without taking any stock market risk. And on top of that, remember, there's still life insurance. We're not getting rid of the death benefit. Now, if she were to, pass away in age 90, you can see that she's drained the life insurance benefit down to about $275. But I mean, think about that. So we took $700,000. We borrowed against it multiple times to maybe acquire productive assets or expand our business or buy rental properties, like all those things that I can't put onto an illustration like this because I just don't know the smart money moves that you guys are going to make to build your family's wealth, right? But that's something that's going to be up to you. But as far as the policy goes, as far as retirement, you put in $700,000, you're projected to take out more than $1.7 million. No income tax on that $1 million of growth because of the way we structure the life insurance. And then sometimes people say, well, yeah, but Ron, it's a loan. Don't I have to pay that back? Not on the retirement income. We're just letting the death benefit pay it off, right? So what's going to happen is if she were to die at age 90, that big old death benefit she has pays off the loan, pays off any of the interest on the loan, and then the remaining amount is $274,676 tax-free to the beneficiary, whether it's husband, kids, grandkids, a charity, whoever you want to name. So this is just an amazing way to kind of set up your own like tax-free income or tax-free pension for later, but without giving up access to your money because you can borrow against it, become your own bank, do all those wonderful things, no stock market risk, and still be covered with life insurance. It's just an amazing way. It's like a financial pocket knife. There's so many amazing different things that you can do. And that's why I'm such a fan of these policies. I've got 9 different cash value insurance policies. 3 on me, 2 on my wife, 2 on each of my kids. And we have just, as our income has grown over time, as I've built up my business, our resources and our means have increased. Every couple of years, I come back and I add one of these insurance policies to kind of re-solidify the foundation of our financial life. It just gives so much safety, so much protection, so much flexibility. It's a great thing. So I hope that this video was helpful, and we'll talk to you guys later. Thanks again for tuning in.